So I'm going to go straight into the first piece on inflation this week, Andy. So if you've been listening to the news, you will have heard that inflation has officially fallen. So the official measure of inflation, which is the Consumer Prices Index, CPI, that fell from 6.8% in July to 6.7% in August. So that was good news. And what was good news about that was the market had anticipated it would actually rise slightly to 7.1%. So if you've been filling up your car lately, you will notice that petrol prices have been rising. So fuel prices have been going up. So that has contributed to an upward pressure on the official measure of inflation, but other things offset it. So the Governor of the Bank of England also came out in recent weeks and said that the downward pressure on inflation was continuing and likely to continue into the end of the year, which is obviously good news. And you would have also probably heard that the Bank of England didn't raise interest rates this time around. So when they had their September meeting, they kept them on hold. And that was because of this surprise fall in inflation just days before that decision was made by the Monetary Policy Committee. So that was all good news. So people might be thinking, right, the cost of living crisis is about to disappear and things will get back to where they were perhaps before 2022. And if you look across to America, even their inflation figures have fallen more significantly than in the UK, actually. They've fallen to 3.6% as we make this podcast. So it seems like inflation's been conquered globally. And that obviously has been partly due to the central banks raising interest rates so aggressively, which has obviously caused tightening on the economy, particularly in the UK. And that obviously deters people from spending, which obviously then starts to bring down demand, which therefore starts putting downward pressure on prices. But not all of the inflationary pressures have been down purely to supply and demand. They have also been, well, in the UK, they've also been down to external factors. And this is one of the things that I want to go on to talk about in this particular episode, because the International Monetary Fund, the IMF, have just released a paper, and the paper was titled 100 Inflation Shocks, 7 Stylized Facts. And the key thing about the paper is they looked at 100 inflation shock episodes across 56 countries since the 1970s. And the paper was looking at how inflation behaved after these shocks, and that would be in response to the monetary policy decisions like hiking rates from different central banks around the world. Now, the paper's findings really underscore the persistence of inflation, and it's a word of warning to the central banks around the world, but also to us as consumers, because there is something called a term of trade shock. So terms of trade shocks are when you get a sudden change in the relative price of exports in a country relative to their imports. So that's an important thing to understand, and we've seen something like that. So an example could be if you get a sudden spike in the price of certain commodities. And the Bank of England earlier this year came out and said that what we're experiencing now in terms of inflation is a result of one of these terms of trade shocks. And if you think about it, energy prices, for example, have spiked, and so they're much higher, partly because of the Ukraine war, but there are other factors as well. We've also seen the oil price in the last 2 months rise 30%. So that is one of the reasons why you're noticing petrol prices are going up at the pump. So I filled my car up yesterday, and probably like lots of listeners out there was actually shocked at how much it cost me to fill up a full tank. So we've had one of these terms of trade shocks, and the reason why that is important is a definition, because the paper from the IMF actually found that in 60% of historical inflation episodes, shocks, that followed one of these terms of trade shocks, inflation was only brought back down within 5 years, 60% of the time. And even in these successful cases, resolving inflation often took, on average, 3 years. So the takeaway from this part of the podcast is that just because inflation is seemingly falling, it doesn't mean we're not going to get a second shock and another wave of inflation and it pick up again. Now, if you're looking at the news, you'll notice things like I said, petrol prices going up. So that is something that is obviously of concern. And we can look at particular episodes in history where we've had similar scenarios and inflation has picked up. So there were oil shocks in the 1970s and lots of countries believed that they'd got inflation under control. So in the UK, for example, inflation fell back from 24% in 1975 to around 8% in 1978. And policymakers were what they would call, what the IMF paper called, prematurely celebrating the conquering of inflation. And the issue was that it then picked up again, and in 1980 inflation hit 18% again. And there are various factors why we saw that resurgence in inflation, and it included wage price spirals, global economic conditions had changed, but it was also because of a premature easing of monetary policy by central banks. So that played a significant role. And what that means is prematurely cutting interest rates. And so lots of people are hoping the Bank of England will cut interest rates. What the IMF paper actually underscored was the scenarios where inflation was generally conquered and we didn't get that second wave was when policy was kept tighter for longer. So they kept interest rates high. So if you fast forward to 2023, what that means is that if the Bank of England is going to conquer inflation that's been caused by one of these terms of trade shocks, then it's going to have to, if you base it upon history, it will increase its chances of success if it keeps interest rates higher for longer. So those hoping for interest rate cuts in the early part of next year, for example, then that is less likely based upon the findings of this paper. Of course, we have to look at different scenarios. Every scenario is slightly different. I can't predict the future, but it's something that people might want to bear in mind. And there was a news piece actually I saw this week that was out there that started to cause a bit of murmurings in the mortgage market about the suggestion that we might have rates at the level for mortgages where they are now in 2 years' time. So when people come to remortgage in 2 years, things won't have necessarily improved. Now that is a bit of crystal ball gazing, but what we've seen in investment markets this week is a realisation from bond markets in particular. Yields have gone up. It's something I'll talk about on the next episode of Damien's Market Update, which will be out in October. But this realisation that for markets that actually we might have to have rates higher for longer. And banks have been hinting at it, but the market just wasn't listening. And so that's caused bond markets or bond prices to fall. We've seen weakness in equity markets. I could go through other examples. There is another example after the 2008 financial crisis where we saw inflation pick up, then fall, but pick up again. Again, it was all in response to premature monetary policy easing. So the takeaway for this piece of the podcast is that be prepared that rates could stay higher for longer because inflation could come back. The cost of living crisis won't necessarily disappear as quickly as some people might hope. And even though the government is hoping to get inflation back below a target level, you see the headlines, and the Bank of England below its own official target of 2%, there is a very real chance that we could see another pickup in inflation. Whoa, whoa.